I hope you all are doing good.
Excellent.
Sorry, I'm a few minutes late, but I am here. And today we are going to dive into episode 4 of Rift Before You Quit.
Right.
And
I
today
love
we are
that.
going to, today, as I promised, we are going to get deeper into the flows and
Recording in progress.
are going to get uh, detailed understanding and detailed information as to how these flows they work, and we are going to have a microscopic vision into these flows, and we are going to break down the myth of retail trading as to how strategies should be and what alignments are there in the professional trading and what sets Rift apart from all the platforms which are there for retail users. So, in most retail platforms, you have. So, before we get into this, let me show you NASDAQ heat map, VIX index, S&P 500. We will discuss it in detail tonight. So these, okay. Before we understand this, let me first build the ground for our discussion as to how we are going to learn and deeply understand and conclude the diversification. Basically, in retail trading world, people usually think diversification means buying more coins, buying more stocks, or using more exchanges. This is what diversification to a retail trader means. But institutional systems think differently. They diversify execution behavior, exposure sensitivity, and volatility response, and participation structure. And that is exactly why Rift introduced Alpha Flow, Smart Flow, and Micro. And today we are going to learn and understand why we have three strategies and why we always win with diversified strategic portfolio. Why single strategy systems fail? The first, objective and understanding is to uh, establish this fact that single strategy models they fail. And if we understand and look closely into the decay chart, uh, then one strategy cannot dominate all environments. Markets constantly rotate between momentum, consolidation, volatility expansion, and liquidity imbalance. So if you and me, we depend on one behavior, eventually the market will break us or it will break you. So when retail traders depend on one behavior model, they eventually collide with an environment where model stops working because the entire strategy shifts or works with one strategy, one uh, model, and that's how we can compare it with single strategy models and why they always tend to fail. So now let's understand why Rift created three flows. Rift was designed around a simple reality. Markets behave differently every week. Sometimes aggressive positioning works best. Sometimes balanced execution becomes superior. Sometimes reduced sensitivity preserves efficiency. And that is why Rift architecture separates capital behavior into three different independent flow structures. First is alpha flow, the high momentum participation layer, in which has a high risk label to you, which has larger allocation in terms of fragmentation of the capital, and it has a multi-cycle structure. In fact, all these strategies, all the flow has multi-cycle structure. Alpha flow is optimized for volatility expansion, strong directional movement. aggressive participation windows, and this flow reacts more actively on momentum conditions. Let's take real market example for to understand alpha flow deeply. If we look at Tesla stock and imagine alpha flow is trading, with this Tesla stock volatility post earning sessions intraday shows 8 to 14% swing, heavy momentum acceleration, and increased liquidity inflows. And this is a volatility expansion example of Tesla stock where alpha flow is basically working or is deployed. So in this example of a single stock or single asset, we can determine and understand when volatility expands, larger directional inefficiencies they appear. And the moment inefficiencies appear, the strategy snipes off the profit. And now we know that alpha flow is optimized for volatility expansion, strong directional moves, and aggressive participation windows. That's how in these environment, alpha flow thrives because when volatility expands, directional inefficiencies increase. And important is to understand high risk does not mean reckless, it means higher responsiveness. So, and then we come to the smart flow, balanced structured participation. In smart flow, we see smart flow is not designed to chase maximum acceleration. It is designed to maintain structural consistency. Let's take real market example for smart flow and compare it with S&P 500 rotational periods. Whenever we look into deep into S&P 500 rotational periods, we have 6 months range bound market, and we can determine during rotational periods, mega caps slow down, sector rotation increases, momentum weakens, and balanced positioning becomes more effective. And that's how market rotation model they function. Smart flow performs differently because it prioritizes balance over acceleration. So when we understand the market is in rotational model, it shifts from different uh, you know consistency flows into different segments, and it is actually a consistency layer that we have built in form of uh, smart flow. It shows that sectors rotate, momentum weakens, and there is no clear direction. In these conditions, aggression fails and balance wins. That's where smart flow performs better because its role is smoother participation, controlled positioning, and reduced volatility sensitivity. Then comes microflow. Microflow is our precision allocation layer. Microflow is extremely important during uncertainty expansion of the market. Let's take real market example for to understand microflow performance in detail. If we look at Federal Reserve rate decision days, real facts are during FOMC events, spreads widen, liquidity shifts rapidly, and volatility becomes unstable. Many institutional systems reduce exposure size before announcement. And from exposure reduction model, we can understand how microflow works and how it actually reduces the smaller execution sizing of the trades, flexible positioning of the trades, lower sensitivity during uncertainty. And this is not a weakness, this is professional exposure management of microflow. Now, after establishing this understanding about three flows, I would want to establish this logic to every single user why you should enable all the three flows to have real diversification layer inside your Rift automated trading engine dashboard. Most retail traders diversify assets. Professional systems diversify behavior. And the reason why I'm saying that because we have built diversification behavior into three different flows, and that's where the entire behavior leads you to stability, precision, momentum driven encashment, and then exposure balance, which creates synergy of Rift execution architecture on which the whole auto trading engine behaves or functions. Alpha flow, which captures stronger expansion opportunities, smart flow, which balances structural consistency, micro flow, which controls sensitivity during unstable conditions. When all the three flows operate together, capital becomes behaviorally diversified. So this is the reason why I always focused on telling you all that you all should own or have diversified portfolio across all three flows. And this information, this understanding will be more established or more concrete, I think, after 6 months of Rift auto trading engine operations by you guys personally. And my job is to make you all understand and aware, and that is what I'm doing. So then we come to compare real institutional comparison between retail behavior and institutional behavior. Retail behavior suggests one strategy while institutional behavior shows multiple execution layers. Retail behavior is emotional switching while institutional behavior is systematic allocation. Retail behavior is reactive positioning. Institutional behavior is structured exposure. Retail behavior is full size entries. The trades which are placed are mostly full sized. If you all remember the example of $1,000 trade that we took in the second session, and same case B of $1,000 trade that we took in five parts of $200 each. So risk gets reduced. The drawdowns are not the impact of drawdown becomes negligible when the position sizing or sizing is done in tickets. Then in institutional behavior, it's dynamic sizing of the trades. This is how sophisticated infrastructure behaves, not through prediction, but through adaptation. Now I will give you flow allocation examples. This is for you guys to have your own strategy. I mean, I'm nobody to suggest, this is not a financial advice, but I am giving you ratios as to how, in an example, you can allocate your capital into three different flows in what ratio. You can take a screenshot of this. If you have all the three flows, then your portfolio can grow in a very diversified, in a very uniform way in all the three flows. As I said, these are educational examples only, not financial advice. Rift architecture differentiator. Now we will understand why Rift is structurally different. Because most platforms provide charts, leverage, buttons. But Rift introduces execution architecture, behavior diversification, structured participation layers, adaptive capital frameworks. The future of advanced participation is not finding one perfect strategy, but the future is adaptive execution architecture. This is why Rift built Alpha Flow, Smart Flow, and Micro Flow. In the next episode, we are going to learn in episode 5 inside the Rift execution layer. We will get inside the Rift execution layer tomorrow on Monday now in the next session. The topics will include how market scanning works, why execution speed matters, liquidity routing concepts, timing inefficiencies, human latency versus system execution, institutional execution models. This is what we are going to discuss in episode 5. Thank you so much, everybody, for joining episode 4. Now I will see you all on Monday. We continue episode 5 with the following, with the above determined topics that we will cover. And I hope in next couple of weeks, you all are going to be really expert in terms of understanding as to why we built Rift is the biggest and I would say the most fundamental fact and understanding that users should have, especially promoters should have, because you all are the flag bearers of Rift in the market, especially in the affiliate marketing industry. And it is very critical for affiliate marketers to understand and to narrate the product, tech wise. And I want my leaders to sound very professional when Rift is presented, in terms of in front of prospects. And this is going to not only improve your sales pitch, not only improve your presentations, but this will make you sound really professional once you are presenting the product to the prospects. So that is it for tonight.